21 miles, that's it. 21 miles is all that stands between the global economy and complete chaos. Right now, as you're watching this, roughly 20% of the entire world's oil supply, 20%, is passing through a stretch of water barely wider than some city limits. It's called the Strait of Hormuz, and if it closes, even for 30 days, your gas bill, your grocery bill, your investment portfolio, your mortgage rate, all of it gets hit hard. This isn't a conspiracy theory, this is geography, this is economics, and in 2026, with tensions between the US, Iran, and the Gulf states running hotter than they've been in a decade, this is something every single person with money in the market needs to understand right now. So stay with me for the next 10 minutes, because I'm going to walk you through exactly what happens to the global economy if the Strait of Hormuz gets blocked, what it means for oil prices, inflation, your stock portfolio, the dollar, and most importantly, what you should be doing with your money today. Let's go. Okay, let's start with the basics, because this is one of those things that sounds like a geopolitics class, but actually has a direct line to your bank account. The Strait of Hormuz is a narrow waterway that sits at the mouth of the Persian Gulf, sandwiched between Iran to the north and Oman and the UAE to the south. At its narrowest point, it's just 21 miles wide, and inside those 21 miles, two shipping lanes, each only 2 miles wide, handle the movement of roughly 17 to 18 million barrels of oil every single day as of 2026. Think about that for a second. 1/5 of all the oil in the world passes through a corridor where the shipping lanes are literally the width of a small town. Saudi Arabia, the UAE, Kuwait, Iraq, Iran, all of their oil export routes for the most part go through this one choke point. And here's what makes it even more nerve-wracking. Iran, which controls the northern shore of the strait, has threatened to close it multiple times over the last 2 decades. Their military, the IRGC Navy, has the capability to deploy mines, deploy fast attack boats, and use anti-ship missiles. They've done military exercises right there in the strait. They've seized tankers. This is not hypothetical muscle flexing. This is documented, real, repeated behavior. Now here's the part that might surprise you. There are bypass routes, but they're limited. Saudi Arabia has the east-west pipeline, called the Petro Line, that can carry roughly 5 million barrels a day to the Red Sea. The UAE has the Abu Dhabi crude oil pipeline, which can handle about 1.5 million barrels a day. But those two routes together cover maybe 40% of the shortfall if Hormuz goes dark. The other 60%? Gone from the market. So when people talk about Hormuz, they're not talking about a disruption. They're talking about the single largest potential supply shock in the history of the modern oil market. And in 2026, with global oil demand holding firm above 100 million barrels per day according to the IEA's latest projections, there is zero slack in this system to absorb that kind of hit. Are you starting to see why this matters to your wallet? Good, because it's about to get more specific. Let's talk about what actually happens the moment a blockade or a closure becomes credible, not hypothetical, credible, meaning markets believe it might last more than 48 hours. Within the first 72 hours of a confirmed Hormuz disruption, oil markets go into full panic mode. And I'm not using the word panic loosely. During the 2019 attacks on Saudi Aramco infrastructure, which temporarily knocked out about 5% of global supply, 5%, oil prices spiked 14% in a single day. That was 5% of supply for one day. Now imagine 20% of global supply suddenly becoming inaccessible, not for a day, but potentially for weeks or months. Analysts from Goldman Sachs, JP Morgan, and the IEA have all modeled this scenario. The consensus? Brent crude could hit $150 to $200 per barrel within the first 2 weeks of a sustained Hormuz closure. Some estimates go higher. For context, in early 2026, Brent crude has been trading in the $75 to $85 range. We're talking about a doubling or worse of the oil price in a matter of days. And here's where it hits you, not just at the gas pump, but everywhere. Because oil isn't just fuel. Oil is inside almost every single product you buy. It's the plastic in your food packaging. It's the fertilizer that grows the crops. It's the raw material in your tires, your clothes, your electronics. When oil doubles, costs ripple through every supply chain simultaneously. Let's put numbers on it. The World Bank estimates that every $10 increase in oil prices adds roughly 0.5% to global inflation. So a $60 spike in crude prices, which is conservative in this scenario, would add 3 percentage points to global inflation almost immediately. In the United States, that could push CPI from its current 2026 levels back toward 5 or 6%. What does 5 or 6% inflation do? It forces central banks to raise interest rates again, or at minimum, pause any rate cuts they were planning. And what do higher for longer interest rates do? They crush bond prices, they slow the housing market, they compress stock valuations, they tighten corporate borrowing costs. It's a full chain reaction. The S&P 500, let's be direct about this, would almost certainly sell off immediately. Historically, oil price shocks of this magnitude have been correlated with 10 to 20% drawdowns in equity markets within the first 60 days. That's not a prediction, that's pattern recognition from 1973, 1979, 1990, 2008, and 2022. Every major oil shock has been followed by equity market pain. And here's the kicker that most retail investors don't think about. It wouldn't just be energy stocks moving. Airlines would get crushed, their fuel costs would explode, logistics companies, shipping firms, consumer discretionary stocks, anything tied to physical goods movement takes a body blow. Even tech companies that run massive data centers would see their energy bills spike. The only sectors that typically benefit? Energy producers, oil majors, gas companies, defense stocks, gold, and to some extent agricultural commodities. We'll come back to that when we talk about what to do with your money. But first, has this happened before? What does history actually tell us? Let me take you back, because while every crisis feels new in the moment, markets actually have a track record with this stuff, and understanding that track record can literally make or save you a lot of money. The first parallel is 1973, the OPEC oil embargo. Arab members of OPEC cut off oil exports to the United States and other Western nations following the Yom Kippur War. Supply dropped about 9%. 9%. Oil prices quadrupled in less than 6 months. The U.S. economy went into stagflation, that nasty combination of high inflation and stagnant growth. That lasted years. The Dow Jones lost about 45% of its value between January 1973 and December 1974. Then came 1979 and the Iranian Revolution. Iran's oil production collapsed. Prices doubled again. The Federal Reserve under Paul Volcker was forced to raise interest rates to 20% to kill inflation. 20%, which triggered the 1980-81 recession. If you think today's rate environment has been painful, look up 1980 and count your blessings. Jump forward to 1990, Iraq invades Kuwait. Oil prices doubled in 4 months. That triggered a U.S. recession. Again, markets dropped sharply. Again, inflation spiked. Now, here's the pattern, and this is important. In every single one of these historical oil shocks, 3 things happened consistently. 1, oil prices spiked dramatically in the short term. 2, inflation followed with a lag of roughly 3 to 6 months. 3, equity markets sold off with the deepest pain in consumer and industrial sectors, while energy and hard assets outperformed. But here's where 2026 is different, and in some ways more dangerous than any of those past events. First, the global economy in 2026 is more interconnected than it was in 1973 or even 1990. Supply chains have been rebuilt after COVID, but they're still fragile. Global debt levels are higher. Central banks have far less room to stimulate because interest rates, while they've come down from their 2023 highs, are not at zero anymore. The policy toolkit is smaller. Second, emerging markets are far more exposed than they were in previous decades. Countries like India, which now imports about 85% of its crude oil, Pakistan, Southeast Asia, these economies would face a simultaneous currency crisis and inflation shock. That means global demand for US dollars surges as a safe haven, which means dollar strength, which creates its own set of ripple effects for American exporters and multinational corporations. Third, and this is the one that keeps analysts up at night, strategic petroleum reserves are depleted compared to 2020. The U.S. Strategic Petroleum Reserve, which was drawn down heavily in 2022 to fight energy inflation after the Russia-Ukraine war, has not been fully restocked. As of early 2026, it's still significantly below its pre-2022 levels. The buffer that was supposed to buy us time, it's thinner.
So the question isn't whether history repeats itself. It doesn't, not exactly. But it rhymes. And right now, in 2026, the rhyme scheme looks uncomfortably familiar. The question is, are you positioned for it? Okay, this is the part you came for. Not theory, action. So let me be direct, practical, and clear. I want to be honest with you up front. Nobody knows if or when a Hormuz closure happens. What we're doing here is risk management, making sure that if it does happen, your financial position doesn't get destroyed. And honestly, some of these moves make sense regardless of whether Hormuz ever closes, because they're just good portfolio hygiene in an era of elevated geopolitical risk. First thing, look at your energy exposure. If you have zero allocation to energy stocks or energy ETFs, you're sitting unhedged against one of the most likely shock vectors in the current geopolitical environment. I'm not saying go all in on oil. I'm saying a 5 to 10% allocation to a broad energy ETF, something like an oil and gas sector fund, acts as a portfolio hedge. When the rest of your portfolio is going down in an oil shock, energy holdings go up. That's the whole point of a hedge. Second, gold. I know, every time there's a crisis, someone says buy gold. But here's why this is different from generic advice. Gold historically performs well in two specific environments: when real interest rates fall and when geopolitical uncertainty spikes. A Hormuz closure triggers both simultaneously. Central banks globally have been net buyers of gold for several years now. In 2025, central bank gold purchases hit multi-decade highs. You don't need to go buy physical coins. A gold ETF or a small allocation to a gold miner index fund gives you that exposure efficiently. Third, commodities broadly. Oil shocks historically feed into agricultural commodity prices because fertilizer production is energy intensive, because transport costs rise, because food supply chains get disrupted. Corn, wheat, soybean prices tend to spike in prolonged energy disruptions. A small allocation to a broad commodities fund, not a single commodity, a diversified one, gives you exposure to this second-order effect. Fourth, and this one is about what not to do just as much as what to do. Don't panic sell your equity portfolio if this event happens. Here's the historical pattern. Yes, markets sell off sharply in the first 30 to 60 days of an oil shock, but unless the shock causes a full global recession, and even then, markets eventually recover. The investors who sold in October 2022 at the bottom of the energy-driven sell-off, or those who sold in March 2020, are still recovering psychologically from those decisions. Panic selling locks in your losses permanently. What you want to do instead is have cash on hand, a real cash buffer, not just your emergency fund, but dry powder in your investment account, so that if we do see a 10 to 15% market drawdown, you can add to quality positions at lower prices rather than being forced to sell other things. Fifth, and specifically for those of you who are holding bonds or fixed income, a Hormuz-driven inflation spike would be very bad for long-duration government bonds. If inflation expectations jump, yields rise, bond prices fall. Shorter duration bonds, inflation-linked bonds, things like TIPS in the US market, would fare significantly better. If you're heavily weighted in long-duration treasuries or bond funds, this is a specific risk to reassess. And finally, the move that almost nobody talks about but is genuinely practical. Review your personal expenses for energy exposure. How much of your monthly budget goes to fuel? If you have a gas car, a Hormuz spike in gasoline prices hits your cash flow directly. That doesn't mean go buy an EV tomorrow, but it does mean having a clear-eyed picture of how exposed your household finances are to an energy shock is valuable right now. This is not about being a doomsday prepper. This is about being a smart, prepared investor who understands the actual risks that are on the table in 2026, not just the comfortable ones.
Here's the bottom line on all of this. The Strait of Hormuz is 21 miles wide, and it has more leverage over the global economy than any single government, any single central bank, any single financial institution. It is the pressure point that, if squeezed, sends shockwaves through every market on Earth. Oil, equities, bonds, currencies, commodities, real estate, all of it. In 2026, the geopolitical tension around that waterway is real. The risks are elevated. The buffers from strategic reserves to central bank policy room are thinner than they've been in decades. And most everyday investors are sitting completely unprepared for this scenario because the financial media doesn't talk about it until it's already happening. You now understand what could happen. You know the historical pattern, you know the economic chain reaction, and you know the specific practical steps to make your portfolio more resilient. Does this mean you should abandon your long-term investment strategy? Absolutely not. It means you should add a layer of geopolitical risk awareness to the decisions you're already making, because the best investors aren't the ones who predict every crisis, they're the ones who are prepared for them when they come.
The Strait of Hormuz might stay open. I genuinely hope it does. But hope is not a portfolio strategy. Preparation is. If this video helped you understand something that most people aren't paying attention to, do me a favor. Hit the like button right now. It takes 2 seconds and it genuinely helps this channel reach more people who need to hear this stuff. And if you want more analysis like this, practical, no-fluff finance content that actually connects the real world to your real money, subscribe and hit the notification bell. I put out new content every week. And I want to hear from you in the comments. What's your biggest concern about a Hormuz disruption? Are you adjusting your portfolio right now, or are you watching and waiting? Let's have that conversation below. I read every comment. I'll see you in the next one.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.